On third countries, this is an issue which has obviously surfaced in EMEA and it's surfaced in AFMD, the Alternative Investment Fund Directive. It's a hugely important issue and one that people don't pay much attention to. In terms of retail, I think we can segment this between retail and wholesale. In retail, I think everybody will accept that we don't want European investors being exposed to cowboys selling them stuff from outside the EU without any kind of regulation. I think that's widely accepted. You need to protect your retail investors. The really tricky thing is how do you apply a third country regime to the wholesale markets? In some cases, EMEA is a very specific example of where you want to use third country clearinghouses. I think again, everybody accepts that clearinghouses are vitally important, huge source of systemic risk. You don't want international arbitrage in the CCP world. So I think it's acceptable to say we don't want European market practitioners essentially using a CCP, and I won't mention any third countries offending them, but a third country where we simply don't think they have acceptable levels of regulation. So there need to be some checks there. But there aren't many CCPs in the world, and it should be relatively straightforward to do that deal. But in MiFID covers such a wide range of services that investors, both corporates and asset managers, are using the services of third country firms all the time, every day. So you have pension fund managers talking to their brokers in Latin America or China. Mr. Barnier just came back from China. He wants us to deepen trade with China. That means talking to Chinese firms. It means talking to Chinese brokers. You're probably going to have safekeeping of assets in China. You need research. I'm sure Simon and his colleagues have got research from all over the world on their desks. Well, providing research is a regulated activity. Investment advice and execution. All these basic services which we regulate, if you like, in MiFID. People are receiving services from third country firms in the course of their everyday business. Investors, corporates need third country firms for help with underwriting. There's intergroup activity which may require a license. Sovereigns need it in underwriting, research as well. So what do you do about it? Well, the Commission have essentially said, so we need to follow this sort of EMEA type approach, we need an equivalence finding, we need reciprocity. These things instinctively sound quite sensible, but if you think about it for a minute, it doesn't work. How are you going, for reciprocity first, it really is not in the economic interest to apply, of the EU to apply a full reciprocity test. It's very important that our pension funds can invest in Peru, as I tend to use Peru. I have no particular affiliation to Peru. Peru is an example. I don't think the Peruvian securities regulator really cares about coming to Brussels and flashing out an equivalence provision. But it is in the interest of us that we can invest in the fast-growing markets in Latin America. Frankly, I don't really care whether their authorities allow them to invest in Europe. I do care. It is good that they should do that, but it shouldn't be a full reciprocity test. It does not make any economic sense. But you will hear the Commission time and time again talk about reciprocity. The reason they do that is because they're looking at Washington. And that's understandable when you look at Washington. But I'm not looking at Washington. I'm looking at the rest of the world. I'm looking at China and Peru, etc., etc. Equivalence, again, a nice idea. And again, they're looking at Washington, and the European Commission can sit down for many years and talk about equivalence. But again, when are they going to get to Peru? When are they going to get to China? When are they going to get to Chile? When are they going to get to Zambia? Right? There are hundreds of countries that we deal with from our investors in particular every day. It isn't going to happen. We can't afford to wait for an equivalence test. So I think we know that's the problem. What is the solution? It's quite difficult to think of a solution. We will propose in our paper a number of solutions. The obvious solution, to be honest, is an exemption approach for the wholesale markets. At least an exemption approach until you find there's a problem, so that the markets stay open and the EU stays open to these third countries. A solicitation test is another option. The problem with solicitation means that, in other words, they can you can call them, but they can't call you. That doesn't really work in many markets. So this is the third country issue. Do you want me to do data protection, data consolidation very quickly?
Well, that's good.
Okay. I should move on quickly to wearing my Reuters hat. And I apologize, these slides may be difficult to see, but there's a lot of lack of clarity of what people talk about when you talk about pre-trade transparency and post-trade transparency and consolidation. So I'll very quickly show you a couple of slides, which I think are in your pack, maybe easy to read in your pack. So if you want to talk about the market data, I've used BMW as an example. Investors need access to the information about the company, they need access to news, they need access to research, and they need access to pre-trade, i.e. prices available to trade on the main markets, and post-trade information. This is the kind of page for BMW. It's there. Specifically, you can see the prices available, the quotes, pre-trade, and you can see the bid-ask spread, and you can see the post-trade, and you can see some sort of more reference data there as well on that slide. I'll do this very quickly. You can look at it in your slides in more detail. Consolidation means consolidating the pre-trade prices available from different venues, and it means consolidating the post-trade prices, post-trade traded prices from different venues. This is a consolidated quote across the different venues. You can see on the right-hand side lists the different venues. Obviously, the main market for BMW is Xetra, the German stock exchange trading system, but there are other markets. There are the local German markets, other international markets that trade BMW. So you can see that information. People tend to not talk about the consolidated pre-trade bit. Post-trade, again, there's a tape. There is a consolidated tape. The vendors, not just Thomson Reuters, the multiple vendors collect this data. You have to buy the data. It's intellectual property. It belongs to the exchanges. We take it under license. We can then distribute it to customers. People can take this information. It's there. That is a consolidated tape from BMW across the multiple venues. Then the question is, investors in particular complain about the accuracy of the data, the consistency of the data, and the price of the data. And very quickly, this is a chart that some of you may have seen before. This shows you on the right-hand side of the screen the consolidated tape. You can see there are blips. These are probably hedges of OTC equity trades in BMW. It annoys the investors because these blips are there. This is the sort of pure electronic Xetra trading, much smoother curve. So the question is, what do you do about those blips? There's been a lot of work done. CISA has got a group looking at accuracy of data. The exchanges and the vendors and have been working together to improve the accuracy of the data under MiFID I. We announced yesterday actually some progress in that space. And then finally, the cost of data. Well, CISA recommends they should be free after 15 minutes. So the question is, what do investors want? Is that enough for investors? I guess for most investors, particularly for best execution purposes, it may well be sufficient for most investors. It would give you a table of record. If you want all the data, it is true, it is expensive. But that's the way it is. It's intellectual property of the exchanges. What happens in practice, of course, is that people tend not to take all the data. You can take some of the data, and I think one of Diego's interests is, well, why don't people just take the main market or one or two of the markets, or indeed a cross-section? You can do that. We suggested there some solutions. It seems to us the question of a consolidated tape, mandatory tape, is a sort of academic one, and I think the buy side in particular need to comment on what they want from that and how it would work, and in particular how the economics of that would work. Okay, I'll do that very quickly.
Guillaume?